On a Friday morning in August of 2025, something happened inside the vaults of the world's oldest financial machine that had never happened before. Gold, the one asset humans have trusted for 5,000 years, specifically because it moves freely across every border on Earth, got stuck. U.S. Customs and Border Protection had quietly posted a ruling. Buried in bureaucratic language, it said that 1 kilogram gold bars and 100-ounce gold bars, the exact bars that make up the backbone of trading on the COMEX, the largest gold futures exchange on the planet, could be classified as subject to import tariffs. Specifically, the 39% tariff aimed at Switzerland, the country that refines more of the world's gold than anywhere else. Within minutes, traders understood what this meant. Swiss refiners halted shipments. Gold futures rocketed to an all-time high near $3,549 an ounce. Spot gold spiked more than 3% in a matter of hours, jumping from roughly $3,290 to $3,398. And somewhere in New York, a trading floor that normally treats gold as the most liquid, most borderless asset in finance, suddenly had to ask a question nobody thought they'd ever need to ask. What happens when the metal itself can't get to the vault? 4 days later, President Trump posted 3 words on Truth Social that reversed the entire episode. Gold will not be tariffed. The rally cooled. The bars started moving again. Most people who saw the headline that week moved on with their lives, assuming it was a one-off, a bureaucratic misfire, a rounding error in a much bigger trade war. It wasn't a rounding error. It was a preview. Because right now in the summer of 2026, the United States is sitting inside a tariff structure that's more aggressive and legally messier than the one that caused that August scare. And gold, already sitting near record territory, already the most bought asset by the world's central banks in nearly 6 decades, is once again sitting at the exact fault line where trade policy meets monetary trust. To understand where gold goes next, you don't need a crystal ball. You need to understand 3 things happening at once, right now, that most investors are treating as separate stories when they're actually one story. By the end of this, you'll see the pattern the way a central bank governor does signal, not noise. The legal chaos is the place to start because it explains everything that follows. In February of 2026, the U.S. Supreme Court did something almost nobody expected. In a decisive ruling, the court struck down the sweeping tariff regime the Trump administration had built using the International Emergency Economic Powers Act, IEEPA for short, the same law used to justify tariffs on dozens of countries at once. The court said a president simply doesn't have the authority to impose broad, across-the-board import taxes using emergency powers designed for entirely different purposes. It was, on paper, a major check on executive power. What almost nobody grasped at the time was that it changed the method, not the goal. Within hours of the ruling, the administration pivoted to a different legal tool, Section 122 of U.S. trade law, a provision meant to address balance of payments crisis, allowing a temporary 10% tariff on virtually all imports for up to 150 days. That temporary tariff went into effect immediately. And as we're recording this, that 150-day clock is almost up. It expires on July 24th, just 1 week from now. That deadline matters more than almost any headline you'll read this month because of what the administration has been doing in parallel while that clock ticks down. Knowing that Section 122 is temporary by design, the White House has spent the past several months building a replacement architecture using slower, more legally durable tools, Section 232 National Security Investigations and Section 301 Unfair Trade Practice Investigations. One of those Section 301 actions accuses 60 countries, representing 99% of all U.S. imports, of failing to crack down on goods made with forced labor. Another is investigating whether 16 major trading partners, including China, the European Union, and Japan, are deliberately overproducing goods to drive down global prices and undercut American manufacturers. Think about what that means in practice. This isn't a temporary emergency measure anymore. This is a permanent, multi-front, legally grounded tariff structure being rebuilt from a different foundation, precisely because the emergency powers version got struck down. One policy analysis, tracking the administration's public trade actions, described it as brick-by-brick reconstruction of the Great Tariff Wall, with new duties approaching the scope of what IEEPA originally allowed. The legal foundation is different. The economic outcome is converging back toward the same place. And that's precisely the kind of environment in which gold behaves strangely, not because gold itself is usually a tariff target, but because of what tariffs represent to markets. Uncertainty about cross-border flows, and about trade relationships that used to be assumed permanent. Gold's relationship with tariffs isn't really about gold as a traded commodity like copper or steel. It's about gold as a monetary asset that happens to move through commodity infrastructure, and that distinction matters more than it looks. To understand why, you have to understand what COMEX actually is. It's not a warehouse, it's a futures exchange, contracts representing a promise to deliver a specific quantity of gold of specific purity at a specific time. Most of the time, almost nobody who trades a COMEX gold contract actually wants the metal, their trading price exposure. But a portion of contracts do get taken to delivery, and when they do, the gold has to physically exist in an approved vault, in an approved bar size, ready to move. That's where the August 2025 scare hit hardest, not the trading price initially, but the delivery mechanism. If Swiss 1 kilo bars, which make up the bulk of the bars actually used to settle COMEX contracts, suddenly carried a 39% import tax, then the arbitrage that keeps global gold prices aligned, London prices matching New York prices matching Zurich prices, breaks down. Traders would have had to either eat the tariff cost, refine bars into different weights to dodge the classification, or stop shipping altogether. Any one of those outcomes injects friction into a market that is specifically prized for having none. This is not a new phenomenon, incidentally. It rhymes with something that happened more than half a century ago, and understanding that older story tells you exactly why today's central banks are reacting the way they are. In August of 1971, President Nixon closed what was called the gold window. Since the end of World War II, the US dollar had been pegged to gold at 35 an ounce, and foreign governments could exchange their dollar reserves for physical gold at that fixed rate. But by 1971, the US was running large deficits. Foreign governments, France especially, were increasingly showing up asking to convert dollars into gold, and America's gold reserves were draining. Nixon didn't ask Congress. He announced on a Sunday evening television address that the United States would simply stop honoring that conversion. The dollar would float. Gold would no longer anchor the global monetary system. What followed over the next decade was one of the most dramatic repricings in financial history. Gold, once frozen at 35 an ounce by government decree, eventually surged past 800 an ounce by 1980 as inflation raged and confidence in fiat currency wavered. The lesson every central banker since has internalized is this: when a dominant power unilaterally rewrites the rules of the monetary system it controls, whether through currency devaluation, sanctions, or trade barriers, the assets that sit outside that system's control become far more valuable, and the repricing, when it comes, doesn't happen gradually. It happens in a lurch. Fast forward to today, and you can see central banks acting as if they've read that history and taken it personally. The clearest turning point came in 2022, when Western governments froze roughly $300 billion of Russia's central bank reserves in response to the invasion of Ukraine. For the first time, reserve managers around the world watched a G7 aligned coalition freeze the sovereign assets of a major economy, assets that were supposed to be, by definition, beyond the reach of any other government. That single event taught central banks a lesson they haven't forgotten since dollar-denominated reserves, and reserves held in any foreign jurisdiction, can be weaponized. Gold sitting in your own vault cannot be frozen by someone else's sanctions list. The data since then tells a remarkably consistent story. Central banks have purchased more than 1,000 tons of gold in each of the last 3 years, roughly double the average pace that prevailed before 2022. In the first quarter of 2026 alone, central banks added a net 244 tons, exceeding both the previous quarter and the 5-year average, and according to Goldman Sachs commodity strategists, likely understating the true pace, since gaps in UK trade data have been failing to capture the full volume of gold quietly leaving London vaults. Goldman's updated model now estimates central banks are buying at a pace of roughly 60 tons a month through the rest of 2026. The list of buyers has changed too. Poland has been the single largest buyer this year, adding more than 20 tons as part of a plan to reach 700 tons in reserves, a decision explicitly tied to security concerns along NATO's eastern flank. The World Gold Council's most recent annual survey, covering 76 central banks and published in June of 2026, found something even more striking. A record 89% of reserve managers expect global gold holdings to keep rising over the next year, and a record 45% say they personally plan to add to their own institution's reserves. That's the most bullish reading in the 9-year history of that survey. and the buyer list has quietly expanded to include countries that had never been meaningful gold buyers before: Guatemala, Indonesia, Malaysia, Cambodia, Uganda, Kenya. Some are buying gold for the first time in their institutional history. Others are returning to it after decades of dormancy. One detail here is worth pausing on: central banks have kept buying and even accelerated their buying while gold prices have doubled. In a normal market, price-sensitive buyers slow down as prices rise. Central banks have done the opposite. As one industry analysis put it, when you're a reserve manager, the price you pay today matters less than what currency your reserves are denominated in over a 10 to 30-year horizon. That's not a trading decision so much as a bet on which monetary system will still be intact 3 decades from now. Put those two halves of the story next to each other. On one side, you have central banks, sovereign institutions thinking in decades, quietly and permanently rotating reserves out of paper claims on other governments and into physical gold they can hold outside anyone else's legal reach. On the other side, you have a U.S. tariff regime that is, in real time, rewriting the rules of how physical goods, including occasionally and accidentally gold itself, cross borders. 2 different actors, 2 different time horizons, reacting to the same underlying signal that the rules governing global trade and global reserves are less stable and less predictable than they were assumed to be a decade ago. That's genuinely fascinating to sit with for a second, because it means the question in the title of this video isn't really about metal. It's about trust in systems. And trust, once it starts eroding at the institutional level, rarely erodes at just one level. Before we go further, if this kind of pattern recognition across trade policy, central banking, and precious metals is useful to you, it would genuinely help us keep making it if you hit subscribe. And if you've got a view on whether central banks are overreacting or underreacting to this environment, drop it in the comments. I read them, and some of the sharpest counter-arguments in this whole conversation come from people who work in trading or reserve management themselves. All right, back to the mechanics, because there's a pricing story here that's just as important as the policy story. Gold's price action over the past 18 months has been genuinely historic, and understanding the shape of that move tells you a lot about what kind of asset gold is behaving like right now. In 2025, gold set 53 separate all-time highs, and for the first time in recorded history, central bank holdings surpassed 5,000 tons in cumulative annual demand tracked by the World Gold Council. The annual average price rose 44% over the course of the year, closing out around $3.431 an ounce. Then in January of 2026, gold spiked intraday to $5.97 and $7.23 an ounce. The highest nominal price in history, driven by a combination of tariff-driven safe haven demand, a weakening dollar, and continued sovereign buying. Since then, the picture has gotten more turbulent, not less. In the spring of 2026, an oil price shock following the US-Iran conflict disrupted shipping through the Strait of Hormuz, pushing oil above $100 a barrel and lifting April inflation to 3.8% year over year, with energy responsible for roughly 40% of that increase. Higher inflation raises the odds of the Federal Reserve holding rates higher for longer, which increases the opportunity cost of holding an asset like gold that pays no yield. That combination triggered gold's sharpest weekly decline since 1983 at one point, and pulled the price back from its January peak down toward the $3,900 to $4,000 in range, where it's traded for much of July. But look closely at who sold and who didn't, because this is the detail that separates a real macro signal from ordinary volatility. Western gold ETFs recorded their largest quarterly outflows since 2023 and the first quarter of 2026. That's the fast money, the traders and portfolio managers reacting to rate expectations, leaving the market. Meanwhile, bar and coin demand from individual physical buyers rose 42% year over year to 474 tons, the second highest quarterly total ever recorded. And central bank buying, as we've covered, didn't slow at all. 2 completely different classes of buyer moving in opposite directions in the same market at the same time. The traders are pricing gold like a risk asset sensitive to interest rates. The central banks and individual physical buyers are pricing gold like insurance against a system they no longer fully trust. Those are not the same trade, even though they're executed in the same market. That divergence is exactly why professional forecasts for where gold goes next are unusually scattered right now, and it's worth being honest about that spread rather than pretending anyone has certainty. JP Morgan has forecast gold reaching $6,300 an ounce by the end of 2026. Deutsche Bank has projected a target above $6,000. UBS has put a figure near $6,200 on the table, and Societe Generale is around $6,000 as well. Those are among the most bullish shops on Wall Street, and their conviction rests on the idea that the structural central bank diversification away from paper reserves has further to run, as JP Morgan put it, a trend they see as largely indifferent to short-term rate moves. On the other hand, plenty of analysts are far more cautious in the near term, pointing to the very real possibility that if inflation stays elevated and the Fed holds rates higher, the trader-driven side of the gold market could stay under pressure for a while yet, even as the sovereign buyer floor holds underneath it. The evidence suggests both of those things can be true at once. That tension is basically the point of this video. Gold right now is not one market with one direction. It's two markets layered on top of each other, a short-term, rate-sensitive, trader-driven market that can fall 5% in a week, sitting on top of a long-term trust-sensitive, sovereign-driven market that has not sold a single meaningful position in 3 straight years of the highest prices in history. Many economists believe that as long as that second layer stays intact, it acts as a structural floor, not a guarantee against volatility, but a limit on how far and how permanently any pullback can go, because in this market, the buyer of last resort is a collection of national governments, not a hedge fund, and those governments have said through their own surveyed intentions that they have no plans to sell. Which brings us back to that ticking clock, July 24th, 1 week from now, when the Section 122 tariff expires. The stakes in that deadline are real, but easy to overstate. If the administration lets the temporary 10% tariff lapse without a durable replacement fully in place, you could see a short window of trade policy uncertainty, potentially compounded by ongoing legal challenges to the Section 232 and Section 301 tools being built to replace it. If, instead, the administration manages a clean handoff into those more legally durable tariff structures, which appears to be the active strategy given the pace of the Section 301 investigations already underway, the effective tariff regime on American trade may end up looking remarkably similar to what existed before the Supreme Court's ruling, just standing on different legal legs. Historically, markets have shown they don't much care which statute a tariff is filed under. They care whether the tariff exists, how large it is, and how long it's expected to last. One possible outcome, if this transition creates fresh uncertainty, the way the IEPA ruling briefly did in February, is another short burst of safe haven demand for gold, similar to what followed the Supreme Court decision. Another possible outcome is a quieter transition that markets largely shrug off, because traders have had months to price in the likelihood that some tariff architecture would survive regardless of the legal vehicle. Nobody watching this video should treat either of those as a certainty. What's certain is only the calendar date, not the market's reaction to it. Zoom out far enough, though, and the specific outcome of any single deadline starts to matter less than the pattern sitting underneath all of it. Since 1971, every major disruption to the assumed permanence of the dollar-centered financial order, the closing of the gold window, the stagflation of the late 1970s, the 2008 financial crisis, and now the 2022 freezing of Russian reserves, followed by an unusually aggressive and legally contested tariff era, has been followed by periods of accelerated gold accumulation by the institutions with the longest possible time horizon central banks. Each time the pattern has looked different on the surface. Each time underneath, it's been the same signal the rules governing money and trade are being rewritten faster and more unilaterally than the previous generation of reserve managers expected, and the asset that sits outside anyone's ability to rewrite is the one they keep going back to. Here's the point worth remembering after this video ends. The headline, "Trump's new tariffs just triggered the COMEX," is really a symptom of something larger, a global financial system where decades-old assumptions about which currencies are safe, which reserves are untouchable, and which trade rules are permanent are all being tested at once by multiple governments for multiple reasons in the same 18-month window. No single test explains why gold is rising or falling on any given day. It's behaving the way it has behaved every time in modern history, when enough powerful institutions started asking the same quiet question at once: what happens to what we hold if the rules we've relied on stop holding? Nobody, including the analysts at Goldman Sachs, JP Morgan, or the World Gold Council, can tell you with certainty what gold will cost on any given day this year. But the data we do have, record central bank buying sustained through record prices, a record share of reserve managers planning further purchases, and a tariff architecture being rebuilt from the ground up after its legal foundation was struck down, all points toward the same conclusion. This looks less like a short-term trade and more like a slow, multi-year rotation. And rotations like this, historically, don't resolve in a single news cycle. They play out over years. If you've made it this far, you now understand this story in a way that most people scrolling past the headlines this week don't. Not as an isolated tariff scare, but as one visible tremor in a much larger shift in how the world's institutions are choosing to store trust. If that kind of long view analysis is useful to you, subscribe, because this is a story that is nowhere near finished, and we'll be tracking exactly what happens when that Section 122 clock runs out. Thanks for watching.